As we go over part 2 of chapter 10, we're going to talk about selling a fixed asset, disposing of a fixed asset, and then how to account for natural resources and intangible assets. So if you think about an asset, you have the asset, the fixed asset means long-term asset, and you have that asset account. It's equipment or it's building, something is on that balance sheet, it's sitting on your balance sheet at cost. And then you also have the contra account, which is the accumulated depreciation account for each one of those assets, okay? And so when you think about disposing or selling an asset, well, when that asset is taken away from the business, you actually have to take that asset off your books, and you also have to take the contra asset off your books. So keep that in mind as we talk about these different scenarios, okay? Now here it tells you eventually an asset wears out or becomes obsolete. Obsolete means there's something better out there and it's no longer useful to you in the business. And so your options would be to discard the asset, to sell the asset, or to exchange the asset. And as I said before, exchanging the assets is covered in the appendix, and we are not going to go over the appendix in this class, although it's there for you to read if you want to read that. So regardless of the type of disposal, there are 4 steps. So the first thing you're going to do is bring the depreciation up to date. So if you're in the middle of the year, you may have some more depreciation which you need to expense. So that's step number 1. Number 2, remove the old disposed of asset and the accumulated depreciation from the books. And we're going to take those off the books in whatever transaction happens. So we'll talk about that. And part of that transaction also will be number 3, where you record the value of what you receive. And then number 4, if there's a gain on the sale of the asset, you'll record a gain. And if there's a loss, you'll record a loss. Now, gains are going to act like the revenue account. A gain would be a credit, and a loss would act like an expense. It's going to be a debit balance. But we're going to look at that as we look at these transactions. First of all, Smart Touch Learning discards equipment with a cost of $10,000, and the accumulated depreciation account is also $10,000. This is what you call a fully depreciated asset. The accumulated depreciation equals the cost. So what's the book value there? Well, the book value would be 0, right? And so the book value is 0, and we have decided to discard this equipment. That means to put it out on the curb, okay? So even if you throw away a piece of equipment, you have to account for that. It's already on your books, and so if you put something out for the trash, then it can't stay on your books. It can't be shown on your balance sheet as one of your assets, okay? So all you would do here if you discard a fully depreciated piece of equipment is you would debit accumulated depreciation to take that off your book. It has a normal credit balance, so you would debit that to zero that out, and you would credit your equipment account for the cost of that particular piece of equipment, $10,000, and it wipes it out. So everything is zeroed out because you have discarded a fully depreciated piece of equipment. Not everything is going to be that simple though. Okay, on July 1st, Smart Touch Learning discards equipment with a cost of $10,000. Oh, same problem. And accumulated depreciation of $10,000. This is showing you the T accounts. And so we just zero that out by that journal entry. Okay, suppose instead that we discard the equipment. It has a cost of $10,000, but it's not fully depreciated. The depreciation, accumulated depreciation, is $8,000. Okay, annual depreciation is $1,000. The first step is to bring the asset up to date on depreciation. So, what's happening here? Let's see if the T accounts are next. Nope. I was hoping they would be. Nope. Okay. So, what happens next is July 1st, half a year has happened. Step number 1, remember, is to record the depreciation to make sure it's up to date. So on July 1st, we record 1/2 of 1 year's depreciation for this equipment, so it's $500. They gave it to us. It's $1,000 per year, so we know it's $500. So you debit depreciation expense, credit accumulated depreciation equipment. At that time, the accumulated depreciation will go up to $8,500. So now what we've got to do is we've got to compare what we get in exchange for this asset, or if we're going to discard the asset, we have to figure out if we have a gain or loss on that discard. Okay, so here we're not receiving anything. We didn't sell it, so we're not receiving cash. We're going to figure out the book value of the asset and see if it actually has a book value. Well, the cost was $10,000. Accumulated depreciation is $8,500. Therefore, the book value of this asset is $1,500. If we put it on the curb, then that is a loss for us of $1,500. And to me, these problems make more sense if you look at a journal entry. So here's your journal entry. In order to discard this equipment, you would credit equipment for $10,000. Okay, so you're taking the equipment off your books. You debit accumulated depreciation for $8,500. Then you see, well, do I need a debit or a credit to make this journal entry equal up? And you need a debit here of $1,500, and that's going to represent your loss on disposal of the asset. And here are your T accounts here. You credit your equipment to zero that out. Now in a journal entry, debits are always listed first, so I'm just showing you the equipment here first because that makes more sense. You're taking it off your books. You debit accumulated depreciation for the full amount of depreciation that you have claimed, and then the difference is $1,500, and we call it a loss on disposal because we have put that out on the curb, and so we're just eating that money, okay? We're just wiping it out. It's called a loss on disposal, and that actually would go on the income statement on the section called Other Income and Expenses. All right, here's another problem. This time we're going to sell the plant asset. On July 1st, the company sells equipment with a historical cost of $10,000, accumulated depreciation of $8,000. Annual depreciation is $1,000, and the first step is to bring depreciation up to date, which we just did. July 1st, half a year depreciation. Now accumulated depreciation is going to be $8,500. The book value is $1,500. Well, suppose we sell this equipment for $1,500. That's an even exchange, so there will not be a gain or loss. Once again, it's easier to understand if you make the journal entry. Well, I'm sorry. Okay, so we get cash of $1,500. So whenever you get cash, that's a debit to cash, $1,500. You debit accumulated depreciation for the amount of depreciation, $8,500, to close out that account, and you credit equipment for $10,000 to close out that account. Because your debits and credits equal, you don't have a gain or loss, so that is your complete journal entry. Now, suppose that we sell that equipment for $4,000. Well, you compare what you get, $4,000, with the book value of that asset to see that there's a gain. And you know that because if you have something with a book value of $100 and you sell it for $200, then you understand that you made a profit of $100, okay? So you understand how profit and losses work. Same thing with the gain and loss. You've just got to realize that you're comparing what you received to the book value of that asset. Once again, it's easier to calculate gain or loss in the setting of a journal entry. You debit cash for the amount of cash you receive. You debit accumulated depreciation for the full amount in that account. You credit the equipment account for $10,000. And then if you need a credit, it's a gain. If you needed a debit, it would have been a loss. Okay, so here you would have gain on disposal. And you also know that gains are going to be reported on the income statement in the other section. All right. Suppose that we sell that same piece of equipment, but instead of for $4,000, we could only get $500 for it. Well, we received $500, the book value was $1,500, therefore there's a $1,000 loss. Once again, let's look at that journal entry. You debit cash for what you received, $500. You debit accumulated depreciation, and if I was writing this on the board, I would leave that third row blank, and I would credit equipment for $10,000 and let my students tell me, do I need a debit or credit to make this journal entry balance out? And I need to debit, so that means that I had a loss on the disposal of that asset. Summary, Exhibit 1010 shows you the different journal entries involved. Be sure and look over that and be familiar with those. Your homework is going to ask you several of those different scenarios. All right, Learning Objective 4 talks about natural resources. Those are assets that come from the earth. They don't depreciate, okay? Fixed assets depreciate. Natural resources are depleted. That means they go away because over time we use those or we harvest those natural resources. Depletion is always computed by units of production. You already know how to do units of production method. You just need to memorize that that's what you use when you're depleting natural resources. So let's look at an example here. Assume that an oil well costs $700,000 and is estimated to hold 70,000 barrels of oil. There's no residual value. 3,000 barrels are extracted during the first year. Well, the first step is to figure out your depletion rate or your depletion per unit. So it's cost minus salvage value or residual value, which is 0, divided by 70,000 barrels is a cost per barrel of $10 per barrel. To figure out depletion expense, for year 1, you would take 3,000 barrels times that cost, $10. Here's your journal entry for the depletion expense. You would debit depletion expense, oil reserves, and you would credit accumulated depreciation, oil reserves, and that's going to be a contra asset to go against the oil reserve account. Once again, on the balance sheet, it would be reported as an asset less the accumulated depreciation, and then the book value would be over here. That subtotal is going to be in the right column. Now let's look at intangible assets. Now there's several different intangibles that the chapter is going to explain, and I'm not going to read about each one of those. I want you to read through this section and make some notes as you go. But the book's going to talk about patents, copyright, and trademarks. Most intangibles are going to be amortized over the cost of the intangible asset's life. It says only intangibles with a definite life are amortized. And for these homework problems, they're going to tell you exactly what you need to know in order to calculate that amortization expense. Okay, intangible assets that with an indefinite life, meaning they don't have an end, are going to be tested annually for their value to see if that value has been impaired or if the value goes down. Okay, and impairment occurs if the fair value goes down. All right, so let's look at patents first. It's an intangible asset, 20-year right to produce or sell an invention. And remember, it could be a process, a product, or a formula. And you would actually debit the acquisition cost of the patent into the patent account if you were to purchase the patent. Okay, so here's what it would look like. If you purchased $200,000 to acquire a patent, you would debit the patent account, credit cash for that. And that is an intangible asset because a patent represents something that might be an idea or a recipe, something like that, not necessarily like a desk or a piece of equipment. So it's called intangible because sometimes you can't touch it. Okay, so to figure out the amortization expense for this patent, you would say $200,000 minus 0 divided by 5 years. And that's going to tell you the useful life there, and it's going to give you an amortization expense per year. But I want you to look at this journal entry. For depreciation expense, we also credited accumulated depreciation. For depletion expense, we also credited accumulated depletion. But for patents, we do not do that, because when we expense a patent, over time, the value of the patent goes away. At the end of the life of the patent, it's not going to be on your books anymore. What you're going to do is you're going to debit amortization expense for that patent, and you're going to credit the asset account called patent. It's a different way of doing that, but that's how we do intangible assets here. And it's telling you they may use an accumulated account. Most textbooks are just going to do it this way, what you're seeing here in the picture. All right, copyrights and trademarks. You need to know the difference between those, so read about those. Franchises and licenses are also intangibles, so read about those. Goodwill is the value that is paid over and above the book value of a business. Goodwill is only recorded when you purchase a company, and goodwill is not amortized. It's not one of those things that we're going to expense out year to year. Goodwill is tested for impairment. Now here's an example of goodwill. White Company acquired Mocha Company. Now, goodwill is only recognized if one business buys another business. So this is not something that happens every year. It doesn't happen all the time. And it's just when someone pays over and above what the business is worth on the books. So that's what we're going to look at here. Okay, the sum of the market values of Mocha's assets were $9 million and the liabilities totaled $1 million. So Mocha's net assets, that means assets minus liabilities, is $8 million. Suppose White paid $10 million to purchase Mocha. Well, if net assets were $8 million and we paid $10 million, that means that we could record $2 million worth of goodwill. It's an intangible asset on the books. You would debit the assets that you purchased. You would credit the liabilities that you just took over. You would credit the cash for the cash you paid, and then you would debit the asset account, intangible asset account called goodwill, and that would be on your books. And the reporting of intangible assets, this is Exhibit 1011, it's just going to show you that plant assets depreciate, natural resources deplete, and intangibles are amortized. So hope this helps you understand Chapter 10. Let me know if you have any questions.